There are 7 growth stocks with massive potential this year. And as a former investment banker, I'm going to walk you through how I select them. I'm going to give you the data points. And you can, of course, also come and learn with me for free. Learn my trading protocol, how I make money in a couple of hours each week. I never stare at screens all day long. That sucks. I like to enjoy my life. Come and join me at felixfriends.org/webinar. But let's get cracking. All of the research, the full presentation you will see here, plus a full benchmark comparison of the key numbers for these stocks is available for free to download at felixfriends.org/tech, felixfriends.org/TECH. So get your pause on that and I shall walk you through this. Here's a stock you might have heard of before if you watched me regularly. Palantir. Yeah, indeed. What do we like about it? What do we loathe about it? Is it one of the top 7? Is it making the list? Well, cash flow is miraculously wonderful. It's growing incredibly quickly. The stock is going up a lot. That's actually not a good thing. It means it's a little on the expensive side. Profit health is decent. It could be better, but they've just delivered their 5th quarter of profitability. So it's all up and up and up. And from here, in my view, it's not cheap. It's just isn't. It's, as I'm recording this, just jumped like 30-40% up. So what's the solution to that? I'm going to show you how you could potentially buy the stock at a massive discount. So stick around till I show you that trade. I'm not going to read you through the profile here. If you don't know what the company does, pause the video, read it. I'm going to assume you know what they do. And let me show you the real numbers that I look at when I assess a stock. And that's what I learned as a banker. Gross profit margins, generally, I want them to be over 60%. In the software space, 80% is sort of the holy grail. They've hit the holy grail. Yay. Revenue is growing very nicely. They are now profitable so that should improve a lot. Return on invested capital is linked to how profitable they are. Given they've only just scratched profitability, you can basically ignore that number. That should end up in the sort of 12 to 20% range for a decent company. So give them a little bit of time. Profits have been growing per year on average, almost 60%. That's a huge tick from me. And that's also what's going to improve the return on capital, which is ultimately what we care about. How much money can we make out of our capital? And the multiplier seems kind of insane, but you can also ignore that because they've only just become profitable. So again, fast forward a year or two, that number might become more relevant. I also have on here their full balance sheet. The one thing I highlight is free cash flow. $697 million in the last 12 months. That's glorious. That's going to give him a ton of cash. And in my opinion, they'll use that cash not to buy a competitor, not to grow insanely faster or hire all these people. No, they'll use it to buy back shares, and it'll put an end to the dilution from share-based compensation. Basically, at the moment, Palantir is handing out shares to their employees to incentivize them, and they're creating those shares, and that's bad for us. It's inflationary. There are more and more shares out there every single year, every single quarter. So they can fix that. That's good news, right? So how do we trade this? How do we buy this cheaper? I would buy this cheaper, and I will make this so that you can actually see it. Hang on, here we go. The tool I'm using here is called optionswatch.io. You can get yourself a free 1-month trial. It's something that we're developing to make it easier for you to make money and understand and get your hands on the same data and tools that Wall Street has. That's my entire ambition with this. What would I do? Well, would you buy a stock that's just run up like this? It's probably not the smartest point. It is a very volatile stock. Very often in the past, when we've had these run-ups, we run up and then we run down. So buying at the top is not usually like massively encouraged. Not saying in the long run it matters, but in the short term, it won't feel very fuzzy. So what I will do instead, I would sell a put option at about $22. This is not financial advice, of course, just the thought. And the thought is the following. It will make you, worst case scenario, 3% in the next month or so, which is not as bad as being kicked in the groin, and therefore something you might want to consider. If the stock does drop below $22, you will get 100 shares of Palantir at the bargain basement price of 21.39. So you kind of have a win and a win. If you wanted to buy 100 shares of Palantir right now, you'd pay 24.91 for it. If the stock does drop, you pay 21.39 for it. If it doesn't drop, well, you made 3% and you're just thinking, oh, I wish I would have bought. But it's better than buying and then it dropping 10%. So it's one way of doing it. It's fairly simple. You literally just sell one put option and you can pick the strike price for that. Play around with that in optionswatch.io. I hope that's an interesting idea. I'm going to skip past the earnings. They have been very consistent of late. One thing I'd like to explain, and I always look at this, and we look at this for every single stock here on our list, and I'm going to pop this back on the chart here, and that is right now, it's not the cheapest stock in the world. Right now, it's trading at, where's my pen? At 75 times earnings. So it takes 75 years of current profits to pay back your share price, essentially, which is a slightly silly way of looking at it, but it's one the market tends to look at. If you did pay for today's share price and the company grew at just sort of 20 to 15% or thereabouts, which is the strange number that analysts are forecasting as a very disappointing growth, in 10 years, you would own the stock at 17.3 times earnings. And is that a little bit confusing? Well, the way to think about that is at a 75x, you are basically making about 1.2% a year on that capital. At 17x, you are making about 5% per year on that. And the way to calculate that is to take 100 and then divide it by whatever the multiplier is. That gives you sort of your return, if you will, on capital, the underlying kind of return. So it's a good rule of thumb to look at and figure out whether or not a stock is a good buy. And now, I think Palantir is going to do much better than these dumbass analysts think. So I think the number is actually going to be much better than that. But that's obviously a judgment call. Now, stock number 2 on our list, which, yes, is also making this list, is another one you might have heard me talk about. It is SOFI. And SOFI has brilliant growth. Cash flow isn't all that great, but it's a bank, guys. Cash flow isn't really a huge thing for banks. They are more looking at how do we make more money out of our money, leverage and all of that. It's just turned profitable. So this D I would kind of ignore because it's the first quarter profitability. Like, yeah, it's good, but it obviously doesn't show up massively yet in the numbers. However, the price momentum is terrible, and that's good. What does that mean? It means the stock is, crashed. And that's a lovely thing. If you want to buy something and pick something up as a bargain, again, if you want to read what they do, take a screenshot, read it. I'll assume here for the moment that you know what SOFI does. Gross profit margins, 81%. That's slightly better than Palantir, and it's absolutely glorious. It makes me want to break out into song. Don't worry, I shan't. Return on invested capital at the moment, still negative. Wouldn't worry about that too much. They've only just started to break into profits. But long-term profit growth is 43% per year. That's also a big tick. Revenue is ticking up. Deposit growth is like 2 to 3 billion a quarter. The more money they have, the more money they can make. It's a bank. I like it. I think banking deserves to be disrupted, and I think they are the ones most likely to do it. I don't think we need to look at the balance sheet in too much detail, but let's kind of move on here. Earnings have been incredibly consistent. They've delivered despite losing kind of their core business growth through student loans and everything else, student loan moratorium. And here, let me run you through these numbers again. So if you divided 100 by the current 58x multiple, you get sort of, give or take, a 2% yield, 2% return, which sucks. If you hold this thing for 10 years, it'll trade only at 3.5x at the current profit growth expectation, which it'll probably exceed. And 100 over 3x, let's call it, would give you a 30% plus return. It could be more. Sorry, I'm writing slightly off the screen here on my brown walls. You can just about see that. So it does seem pretty good value to me. Obviously, not financial advice, but here we are. Let's move swiftly on to the securities sector. And look at that. It says great here. Great. How often do we see a great? Not very often. Very, very, very rare. And the company is Fortinet, which is a cybersecurity business. And if you hear that JP Morgan, I think, gets hacked, I don't know, 1 billion times a day or something like that, they're spending billions a year on that, as will every other, not just financial institution, but anybody who does something critical, anybody who's significant, a Microsoft, a power company, a pipeline company, an airport, an airline. They're all getting hacked by competitors, blackmailers, foreign governments, and the spend to defend is going to go up and up and up and up, because to hack will get easier and easier and easier because of AI. I don't know why I keep repeating every word 3 times. I sort of think it might do it for emphasis. But there you are. Cash flow health is wonderful. Growth health is wonderful. Price momentum is a little bit going up too much if you are not in this yet. Profit health is glorious. Relative value is pretty decent. A D means it's not cheap, but it's also not insanely expensive. It could be an E or an F, as in a fail. So this looks pretty good. They basically provide cybersecurity stuff, right? That's basically what they do. Again, if you want to read this, slow it down, pause the screen, and you can read that in its full glory. Gross profit margin at 76% exceeds my 60% plus target. It's a software business, essentially, so they're doing pretty well. Revenue going through the roof. They're making over $1 billion profit on 5 billion revenue. That's pretty good. And don't know why we haven't got a return on invested capital data here. It's sort of got hacked. Somebody needs Fortinet and long-term profit growth at 15%. I always look at that number and think, well, if it goes up 15% per year, it's fairly likely the stock's going to go up 15% a year in the long run. So I'm happy. And yeah, I like it. In terms of numbers, look at this. Free cash flow, $1.7 billion. Which means they're never going to need to borrow money. They don't need to dilute you by printing shares. They could take over whatever they want. They can invest. They can buy back shares. They could even pay dividends. All sorts of crazy ideas. And it's a insanely profitable business. Absolutely love it. Earnings, very, very consistent. I always focus on the earnings per share because ultimately I care about profits. Revenue moving up or down a teeny tiny bit doesn't really matter. They've been consistently beating market expectations. And how cheap is this thing? Well, not super cheap, but also not super expensive by what we've seen. 40x is the PE. So if you divided 100 by 40 and did that so you could actually see it on the screen, then that gives you a 2.5% yield right now, which sucks. But you held on to the thing for 10 years. And honestly, for growth stocks, you want to hold on to these things. It's 15x, so 15. That's about, and there's a sort of back of envelope maths, that's about a 7% yield. So you get a significant improvement. Now, this is assuming pretty miserable growth down the road by some depressed analyst out here. I don't see that. I think growth will be significantly better. So I think the yield will definitely be in the double digits. I say definitely. Nothing is obviously definite, but that's the way I look at that. Next one, also one of my favorite little tech stocks is Path, UiPath, one of the Cathie Wood favorites, which made me question myself quite a lot till I thought, well, she could be right occasionally, couldn't she? And cash flow health is brilliant. Price momentum is not terrible, which is a good thing. Actually, not brilliant, which is a good thing, because price momentum means the stock hasn't gone up that much. Profit health, yeah, so, getting there. But it's growing. Oh, she's growing. And relative value is reasonably attractive at this point. What do? Basically, mini robots, sort of mini automations. Simple automations is what they do. That's why people like it. Simple is always easier to sell than complex, hence Palantir. And gross profit margin, 84%. That's the best we've seen so far, isn't it? Do we have an 87? Maybe we did. It's pretty good. Anyway, they're not profitable yet, but look at the chart. Look at the chart. Let me zoom in on it for you here. almost there, right? Almost there. So that's pretty good news. And same with return on capital. Profit growth is 35% a year. That's a big check from me. So they are moving very, very much in the right direction, which I like to see. Financials, look at that. Free cash flow. 240 million free cash flow on a 1.2 billion revenue. It's pretty good. So again, they're out of the woods. They're out of the Cathy Woods, and they no longer need to raise capital. They don't need to go to the market. They don't need to dilute you. They don't need to issue bonds. So any of that nonsense, they're printing money. They're starting to print money, and that's the spot when companies become attractive. They have been very consistent with profit and revenue beats compared to the market every single freaking quarter for 2, 4, 6, 8 quarters in a row. 2 years. That's pretty impressive. So management is up to the task, I would say. How about valuations? Well, the market doesn't love this stock. So right now it's trading at, let me move this over a little bit so you can see it. Right now, this is trading at 51 times profits, which is insane. Now, 100 divided by 50 gives you a 2% yield. How depressing is that? If you believe analysts, in 10 years, you will get 100 over 31, which is about a 3% yield. That's also super depressing. But why would they not grow 180% this year, then 9% next year, then 4% minus 37%. So this analyst is just on crack. They're onto something. These numbers are nonsense. I think they're going to far outperform that and give us a decent return. At least that's my view on it. One more time, and I think we have one more after this as well. There will be timestamps down below, so I suppose you already know this. CrowdStrike, what do? Something fairly similar to Fortinet, cyber security. So why do we like it? Because it's growing like a beast. It's a little expensive, but not massively expensive. Profit health, so. Let's look at the underlying numbers. Again, you can see what they do. They do cloud-delivered protection across endpoints and cloud workloads, identity and data. Sexy, isn't it? But it's profitable. And gross profit margin, steady she goes. 74%, that's pretty good. Revenue taking off almost at profitability. And that's what I like. I actually quite like getting into growth companies just before they are profitable. Like the quarter before, because once it's profitable, people get on people's radars. A lot of institutional investors, fund managers are not allowed to buy loss-making companies. So they'll ping up on their little sheet when they go, oh, they're making money, and then they start to dig into it, and a quarter later, they're all in on it. Plus, when you are profitable for 4 quarters, you can get into other indices and so on. And profit has been growing at 40% per year over the last couple of years on average. So that's pretty good stuff, right? And 2.8 billion revenue. Do we have free cash flow? Yes, we do. Almost $1 billion free cash flow. You think this is a good business, or you think this is a great business? I think it's a great business. You make $900 million cash flow on 2.8 billion revenue. You're doing something right. You've got a subscription business. People are paying you up front for your service. And to deliver it is pretty freaking cheap. Otherwise, you wouldn't be making that kind of money. And look at the glorious green earnings per share beat numbers every single freaking quarter for 2 years running. So management doesn't have their head in the sand or up their own backside like certain regional banks or the lot of Disney that we shan't talk about today, because apparently that is not the right thing to do. You might offend people who identify as monkeys or mice or dolphins or something. Anyway, return on capital at the moment, well, 100 divided by 109, which is the current PE, is like, oh my freaking God, what is that number? That makes no sense. So yeah, it's insanely expensive right now. But even with the pessimistic, gloomy, miserable analysts' expectations of growth and the sort of mid-20s in the long run, you will get to a 15x, which means 100 over 15 is something like 7% yield. It could be a lot better if the Russians keep hacking us. So I like it. I think there is improvement there. I think the numbers are going to look a lot better when profitability kicks in properly. And here we go. Here we've got Tesla. What do they do? Have I heard of this company? Well, why do I like it? I like it more the less the market likes it because it's getting less expensive and the company's actually getting better. And that's one of those weird things that seems to happen. You get this fast growth company everyone's excited about. You hit a bit of a plateau. It comes down a bit because management is focusing on longer term growth rather than on short term pleasuring of its shareholders. And therefore, everyone goes a little bit nuts. And that's, I think, the moment with the lowest risk, highest reward, rather than being one of the earliest investors. Yes, which paid off very handsomely in this case, but it can also be super risky. So cash flow, brilliant. Growth, amazing. Profit, brilliant. And it's nice and cheap. Price momentum sucks, which is exactly why I'm looking at this. And you know what they do. I'm not going to bore you with it. Gross profit margin, 18%. Oh, the horror. Why the horror? Should it not be more than 60%? Yes, it should be, but they're a manufacturer. And yes, they do manufacture cars. It's actually a car company at this point. And therefore, they've got these dreadful profit margins. But, as they say in Middle England, should I translate that? That means but, not the one you're sitting on. If they can pull off one of the two things, which is turn themselves into some sort of AI self-driving business, or can pull off robotics, this thing will explode. And otherwise, they're just going to be one of the most profitable car manufacturers out there, which also isn't such a terrible thing to do. 96 billion revenue, 14 billion or 15 billion of that is profit. That's pretty freaking decent. So what they've actually done is that their profit margin is better than what the gross profit margin looks like because they're super efficient. So after the initial overhead of selling the vehicle and making it, they've got very, very, very lean cost structures. So they're actually looking much better there. Return on invested capital at 12%, just about hits my threshold of 12% plus. Profits growing at 19% is pretty good. So I always combine these numbers and I go, well, should it therefore not go up by 12 to 19% per year? Is that not the logical conclusion? I kind of seem to think so. Bit of, beer maths, but you get the idea. What about free cash flow? Oh, yes, she's got free cash flow, 4 billion a year. So they've got money to invest. They've got money to buy back shares with. They've got all sorts of money. And that's a good thing. They will never tap the market again. At least I don't think that they will. Earnings, yeah, been a little bit disappointing in the last 2 quarters. That's why I think this is actually an opportunity. It's one of those moments where they're investing and growth is going to come a little bit later. And is it cheap? No, it's not super cheap. So 59x is the current PE. So 100 over, let's call it 60 is what? 1.4 or something like that? My maths. What's 100 over 42, right? 1.2% yield sucks. But if you wait 10 years at the miserable growth that the market's forecasting, 8%, 12%, that sort of thing, you get to a 10x PE, which means you would make a 10% yield, which is pretty decent, which would mean the stock would go up at least that much per year, probably more. Now, what about the last one? The last one is a ticker called YOU. It's something that, lives in your head. And honestly, if you don't buy any of the stocks above, and you don't do any research whatsoever on this, of course, you should do your research before you buy anything. If you wanted to do one thing today that would actually make a meaningful impact, it's you'd invest in yourself. And that sounds a little bit cheesy, but the best thing you can do is to actually understand and learn more every single day about investing and managing your money and maybe trading it. Because time is your enemy. There's literally a clock here which is running against you. And let me give you a little bit of motivation and insight on that. Say today you had $30,000. That was your portfolio, and you put it in the S&P, and you did 12% a year return, which is slightly less than what the S&P has done the last 10 years. That $30,000 would become basically $600,000. So you would make pretty much a 19x return on your investment. You could do a lot worse, but Nobody can frickin' retire on $600,000. Sorry to break it to you. If you think that's possible, you can't. Unless you're going to live somewhere in the woods with a yak. It's just not going to happen. So what could you do? Well, what if you could figure out a way, and I would make that my number one priority, to add $1,000 per month extra into your portfolio, no matter what you're doing right now. That would mean that over the next 25 years, you would add $300,000 extra into your portfolio. That $300,000 plus your $30,000 would then become $2.5 million, still the 19x multiplier. So the most important thing you can do for yourself is to increase the amount of money you invest. How do you do that? You need to find an extra income stream. And you're like, I'm busy, I've got jobs, children, golden retrievers coming out of my ears. And I hear you, but you got to figure out a way, because unless you put in the extra money, you are not actually going to get to that financial freedom. And of course, you don't have to wait 25 years. You can do it much, much more quickly. So find that side hustle. For me, the side hustle is trading, because I can do that literally in like 2 or 3 hours a week. Very, very little time spent. And I can make extra income from the capital I already have. And you might think it's complicated. You might think it's risky. They are all preconceptions that people have because society's trained you that way. The banks have trained you that way. The financial advisors have trained you that way, because it's their incentive to keep you dumb and uninformed. If you're still watching this, I already love you, because you have a lot more patience and determination than the vast majority of people. So come and join me on Tuesday, and I'll teach you how I make money from my money. I'll give you the system. I'll give you the rules. We'll do some live trading together. It's super simple. It's just 3 things I do again and again. It's fully automated. It takes very little time. You don't need to stare at screens. You can have jobs. I've taught like 9,000 people so far. It really is not rocket science. Come and join me. FelixRenzer.org/webinar. Thank you for watching and smashing and sharing and all the good stuff you could possibly be doing with this video, and see you on the next one.